So our first topic is value added tax. Value added tax. Now let's write. I'll just summarize what is important for value added tax. Then I had shared the notes with you. Now for taxation, I'll be sharing the notes in advance. It's only for today, I'll do some dictation. All the others, I'll be sharing the notes in advance, then we shall just be discussing them. And this is because I have allocated only one class for advanced tax. Yeah, actually, for the last 2 years, I have been allocating only one class for advanced taxation. The one for Saturday, even I was not aware, someone was reminding me that there is a class that was put there by Mr. Dishon. Yeah, but that class will not be there. So what will happen is that with time, there is some time I'll be alternating. Instead of AFR on Sunday, I interchange. We take a break for AFR, we do taxation. But even if I don't give you another class, we shall complete our syllabus and we do revision. Even for intermediate level, they only have one class. Yeah, so kindly don't be worried. Yeah, we have a strategy for that. Good, value added tax. So kindly cooperate for taxation. From next class, I share the notes. Be printing them in advance, so we shall be discussing. You have the handout and the past paper. I'll be sharing the notes in advance. Good. Value added tax, where do you see that? This is the tax. This is the tax. This is the tax on the value added. This is the tax on the value added. This is the tax on the value added. And is corrected by registered traders and is corrected by the registered traders. Is corrected by registered traders on behalf of the government. It's corrected by the registered traders on behalf of the government. On behalf of the government. VAT is usually included. VAT is usually included in the product price. Is usually included in the product price. Product price, and therefore it's an indirect tax. And therefore it's an indirect tax. An indirect tax. Then we have to see that. It's provided at the rate of 16%. It's provided at the rate of 16%. Yeah, that's what the Income Tax Act provides for 16. But sometimes, don't write, it might change. Yeah, it may be affected through the finance bill. So for example, it can be 8%, but that's not what is the Income Tax Act. The standard rate is 16%. Anyway, we see that? VAT is payable on or before. VAT is payable on or before 20th of every month, or on or before 20th of the month, on or before 20th of the month following the month of supply. Following the month of supply. On or before 20th of the month following month of supply. Yeah, that, for example, the VAT for June should be paid or filed on or before 20th of May. Where? At least We can proceed. Now we are saying that if the tax remain unpaid, what had I said? There is something I had mentioned. Yes? Yeah, if the tax remain unpaid, on the due dates, it attracts a penalty. Of 5%. It attracts a penalty of 5% of the tax due. 5% of the tax due, and an interest of 1%, and an interest of 1% per month compounding. An interest of 1% per month compounding. Yeah, there was a change. There was a time they used to charge 2%. Nowadays they charge 1%. The penalty is 5% of the tax due. So that means if they were supposed to pay VAT of 500, so now you'll pay 5% of this, and then depending on the number of months, 1% per month compounding. What about late filing? Late filing, it will attract a penalty. No, you don't have to write that one. That one we just need to remember. It will attract a penalty of, most of you have been doing this, Late filing. It's 5%, the same 5% of the due tax, or 10,000 per month, thereof off. Are you together? Thereof off. Good. So now let's look at terminologies. Look at some terminologies. Number one, input tax. Input tax. Input tax, we like to see that. This is the tax. This is the tax. And this is the tax. Paid or payable. Paid or payable. This is the tax. Paid or payable on the surprise. On the surprise by. On the surprise. So on the surprise to a registered person. On the surprise to a registered person. The surprise to a registered person. On goods or services. On goods and services. On goods and services. On goods and services. Goods and services. Used by him. Used by him. Used by him. For the purposes of his business. Used by him for the purposes of his business. Number two is the output tax. Output tax. You see that? Is the tax due? Is the tax due? Is the tax due on taxable surprise? Is the tax due? Is the tax due on taxable surprise? Yeah, later you'll come to discuss about on how we come up with the VAT account. Now, in this case for VAT account, here you have the output tax. Now, the output tax is the amount of the VAT you charge when you're selling the goods, and then the input tax. Now, the good you are selling, you had already purchased them. And when you're purchasing them, they were inclusive of VAT. Now, that's what you call the input tax. Good. Another terminology, number three. Tax period. Tax period. Tax period. Okay. Is a tax period. We like to see that. This means 1 calendar month. This means 1 calendar month. 1 calendar month. I file VAT on a monthly basis. This means 1 calendar month. Another terminology, taxable surprise, taxable surprise, taxable surprise. You see that? Their surprise other than exempt surprise. Their surprise other than exempt surprise. And that's the definition as per the Income Tax Act. Taxable surprise, their surprise other than the exempt surprise. Those are exempt surprise. Those are surprise which are not vatable. They are not subjected to what? To VAT. So that means the taxable surprise, they are surprise which are subject to what? To VAT. Correct. And now let's look at another one. Number 5, time of supply. Time of supply. Time of supply. This shall be the area of. This shall be the area of. Semicolon. A. Semicolon. A. Date on which the goods. Date on which the goods are delivered. A date on which the goods are delivered. Or service performed. Or service performed. Or service performed. Number 2. Date on which invoice on supply, date on which the invoice on supply is issued. Yeah, invoice on supply is issued. Number C. Date on which the payment is made. Date on which the payment is made. Date on which the payment is made. Either partially or in full. Either partially or in full. Either partially or in full. And lastly, number C. Number D. Date on which the certificate. Date on which the certificate by the contractor is issued. Yeah, now for tax purposes or for VAT purposes, that's how we determine the time of supply. The area of either the date when the goods were delivered, the date in which the service was performed or the goods were delivered, the date also in which the invoice for the goods was issued, or the date when the amount was paid. Now, this is what it means. Now, for example, in the month of June, your company made some sales to a customer worth 1 million, inclusive of VAT. But customer will pay after 3 months. The customer will pay after 3 months. You had already made the supply, but now you need to pay the tax. You need to file the tax for this month of June. Now, will you factor in this? Will you pay the VAT on this? Now, let's assume that the VAT on this is 160. Will you pay? But note that the customer has not yet paid. Hey, you'll pay after 3 months. Will you pay that VAT? Yes. The area of, number 1, the date in which the goods have been delivered. You have already delivered the good, even if you have not yet received the payment, or the date in which the invoice has been issued, or the date when the payment has made either in full or partially. Because sometimes we have some customers who pay in advance. So whenever the customer pay in advance, even if the good will be delivered after 3 months, so when the customer pays, that's when you need to file for that VAT. Good. Then we write something else, another paragraph. Write another paragraph. A registered person shall not deduct, a registered person shall not deduct input tax, shall not deduct input tax, shall not deduct input tax, if it relates to, number one, acquisition of passenger car, or minibus, including its repair cost, Number two, entertainment expenses. Another one, catering expenses. Another one, restaurant and accommodation services. Yeah, what does that mean? Now we have said that. Now let's go back to that statement again. We have said that a registered person shall not deduct input tax if it relates to. Now, in short, we have what we call allowable and disallowable expenses. Now, how do you determine the VAT? Now, when determining the VAT, we'll come up with what we call the VAT account. I'll give you the format. Now, for the output tax is amount you collected on behalf of the government. So that means you need to remit. So you factor things to do with the sales. How much was the VAT on the sales? But remember, on your side, the good you sold, you had purchased them. And your supplier had also charged you the VAT, right? So you need to claim that VAT. So what you are claiming is what you call the input tax. Now, the input tax will reduce the amount of VAT you are supposed to pay. So, for example, you have the purchases, some expenses. You know, you have some expenses we consume that were already included inclusive of VAT. But there are some things which are vatable, you should not claim. Now, that's what now we have indicated, that a registered person shall not deduct. In short, that's what we call a disallowable expenses for VAT purposes. You cannot go and claim that. So number one, it relates to what? Acquisition of minibus or passenger car, or entertainment what? Expenses, or catering expenses. Yeah, for example, catering services. Are they okay? Are they vatable? If you go to a hotel and you eat, it's vatable. Now, in that case, you cannot say that. Now, our company, these were the sum of the expenses of which we already charged the VAT. In that case, you cannot claim. But that service itself is vatable. Are you together? You are already paid, but you cannot claim. Another one was what? Restaurant and accommodation services. Good. Then you like to see that? Another paragraph. When a registered person, it's another point, itself. I mean, okay, not in that. Had another paragraph. When a registered person makes the three types of surprise, comma, input tax deductible, shall be restricted as follows. When a registered person makes the three types of surprise, the input tax deductible shall be restricted as follows. Yet what we call now deductible input tax. Deductible input tax will be restricted by taking what we call the taxable surprise. You divide by the total surprise, then you multiply by the input tax, not by the import tax. Can I show that? You see that? This is applicable. This is applicable. This is applicable. This is applicable. Where the value of exempt surprise, this is applicable. Where the value, this is applicable. Where the value of exempt supply, the value of exempt supply is more than 10%. The value of exempt supply is more than 10% of the total supply. 10% of the total supply. Now let me make you understand that point. And you think that where the registered person makes all the three types of supply. Which are those types of supply? Now we have three types of supply. Number one, we have what we call the standard rate. Standard rate supply. And those are the supply which are taxed at a normal rate of 16%. Then we have what we call zero rate supply. And these comprise only the exports. Yeah, the exports are not vatable because they'll be vatable at the other point. Then number three, we have exempt supply. You can show that types of supply, write them. At number one, we have the standard rate supply, and this one is at the rate of 0%. Then we have zero rate supply at 0%, and then we have exempt supply. And those are supply which are not vatable. Sorry? Sorry? Yes, like firearms. Also, we have medical supplies, first aid kits. Yeah, all that. Yeah, now you're saying that if the company makes all the three types of supply, you cannot claim everything here, the input tax. Now, in that case, the input tax shall be restricted. And how shall it be restricted? Into proportion. This is how you get the proportion. Therefore, to get the deductible input tax, you take the taxable supply. Now, the taxable supply is a standard rate and zero rate. Even zero rate, they are taxable at the rate of 0%. So you take the standard rate plus zero rate supply. That's what you call the taxable supply. And then you divide now by the total inclusive of the exempt supply. Good. NB. Number one. Tap water is not vatable. Tap water is not vatable. That means they are exempt. Number two, purchase of safety equipment. Purchase of safety equipment. Purchase of safety equipment are tax exempt. Are tax exempt. So that means they are not vatable. They are tax exempt. Also, treatment cost of natural water is not vatable. Treatment cost of natural water is not vatable. Now, let me ask you a question. If you buy a bottled water, Dasani, do you pay VAT? Yes, but now the VAT you pay is not based on the water. They usually do charge in the name of the bottle. And that's why different brands, we say that what is VAT? Is the tax on that value value added. Now, the cost incurred to treat that natural water will not be vatable. But now, you pay expensive because of that water. Now, that value is what now they tax. Another one, write another one. Services from the county government, services from the county government are not vatable. So you need to understand that. If you offer services to the government or to even county government, it will be vatable because you are supplying to make profit, right? Yes, so you are profit oriented, that's why you're supplying the good. So there is value added, so it will be vatable. What about the service now from the government? Government, they do not offer service to make the profit, right? The major objective of the government entities do what? To offer services to the members of the public. Commercial entity, they are there to make profit. If you are there to make profit, there is value added. From the government, they are not. For example, if you pay the parking fees. Parking fees. Do they charge? Okay, VAT is the amount collected by registered trader on behalf of the government. Are you together? Now, this is the government offering the services. Can it collect VAT on its behalf? No, because you're saying that in that case, they are there to offer services, not to make the profit. But if they are one offering the service to the government, they'll charge VAT. Another one. Private garbage collection. Private garbage collection is vatable. Private garbage collection is vatable. But if it's provided by the government, just like county government, because that's something which is developed. But it's corrected by the county government, it's not vatable. It's not vatable. Good. Yeah. So now let's look at subheading. Registration for VAT. Registration for VAT. Registration for VAT. There is something I've been mentioning here. I've been talking about registered person. Not everyone collects VAT. Not everyone collects the VAT. Now, for example, if you go to supermarket, do they charge VAT? Yes. What about the normal kiosk? No. Why? Because you're saying that this is the amount you are collecting on behalf of the government. So that means not everyone who qualifies to collect. So what are the process for you to qualify or to be registered for VAT? Number one, don't write. Don't write. First of all, I wanted to explain. For you to register for VAT, your annual sales should be at least equal to 5 million. What if you're a new business? That means you don't know how much you'll make. But in case now you expect your revenue might exceed 5 million, you can register for what? For VAT. Then there is another exemption. We have those entities, they are there not just to make profit. And sometimes they don't expect their revenue to be more than 5 million, but they wish to have what we call voluntary registration. They just collect on behalf of the government. They can apply and convince the commissioner that they can be able to collect. Yeah, that's what we call, you register for what we call voluntary registration. That's right. I need to say that. A trader should register for VAT. A trader should register for VAT if the annual sales are more than 5 million. If the annual sales are more than 5 million. Full stop. Then I have to see that. Notwithstanding subsection 1, notwithstanding subsection 1 of the Income Tax Act, notwithstanding the subsection 1 of the Income Tax, comma, a person who makes or intends to make a person who makes or intends to make a taxable surplus, person who makes or intends to make a taxable supply may apply to the commissioner, may apply to the commissioner, may apply to the commissioner for voluntary registration, may apply to the commissioner for voluntary registration. Good. For a person to register, another point, for a person to register for voluntary registration, for a person to register for voluntary registration, comma, the commissioner must be satisfied. The commissioner must be satisfied. The commissioner must be satisfied. Must be satisfied that. Semicolon. Number one, the commissioner must be satisfied that. Semicolon number one. The person is making or shall make, the person is making or shall make taxable surprise. The person is making or shall make taxable surprise. Number B, the person has a fixed price. The person has a fixed price from where the business is conducted. Has a fixed price which the person or where the business is conducted You must be having a physical location, yeah, whereby they can come and look for you to do your audit. Another one, if the person has commenced carrying on a business, if the person has commenced, carrying on a business, comma, has kept proper books of account, has kept proper books of account, has kept proper books of accounts. Good. Look at something else. VAT record keeping. VAT record keeping. You see that? VAT records should be kept for a period. VAT records should be kept for a period of 5 years. Should be kept for a period of 5 years from the date of the last entry. From the date of last entry. Yeah, at least 5 years. Actually, most of the accounting documents, mostly anything that date to tax, should be kept for a period of a minimum of 5 years. Sio kutupa receipt and weka hapo kwa system. No, you need to keep them. Why? Because we'll come to cover later something we call the back duty and tax investigation. When someone is under tax investigation, sometimes they don't just investigate 1 year. Sometimes they might investigate 4, 5, or even 6 years going backward. So in that case, you need to have those records. You have a department within the KRA which does that investigation, the tax investigation department. I need to say that the foreign record should be maintained. The foreign record should be maintained. The foreign records should be maintained. Number one. Copies of all tax invoices. Copies of all tax invoices. Number 2, copies of all debit and credit notes. Copies of all debit and credit notes. Number 3, VAT account. Another one, copies of all stock record. Copies of all stock record. Another one, Details on each supply, details of each supply of goods and services. Another one. Sales and purchase invoices. Sales and purchase invoices. Yeah. Good. So those are the some of the documents that need to be maintained for a period of a minimum of 5 years. So now, how do we determine the VAT payable? So I want to give you the format of VAT account. Don't copy, first of all reason. When determining the amount of VAT payable, you take the output tax minus the input tax. So how do you determine the input tax and the output tax? So for the output tax, it's based on the taxable supply, things to do with the sales that at standard rate. Also, we have the exports. Yeah, we see that exports are zero rated. Also, we have debit note issued. But in case of credit note, you have the credit note issued. But for the credit note, you deduct. Now, what gives rise to credit note? Credit note. Now, let's move from tax. We move to accounting. Returns, correct? It's return what? We have two returns, return inwards and return outwards. So this return, yeah, return inwards. You see, in this case, you had already made a sale, but the customer returned the goods. So that's why you're doing what? You're deducting. So we have the credit note issue. Then here we have the input tax. Now for the input tax report, now you need to claim to minimize the amount of VAT you are supposed to pay. And number one, we have the purchases. And only the purchases from a registered trader, the purchases of the goods that you bought, which were inclusive of VAT. Then also you have imports. Now note that most of the imports are exclusive of VAT. If you buy a product, that product is inclusive of VAT. But for import, they're exclusive of what? VAT. How do they adjust? If you import something, now to the port you come as CFI. That's the cost, freight, and insurance. Then from there, you know, our revenue authority at the first point, they have to charge you something. What we call the import duty. But you tax. So, and that's why we say that when you export something, it's zero rated. Even from the other country, it's zero rated. Why? Because where this product is going, at the first entry point, it will be taxed there. So you take the CFI, that's the cost, insurance, and freight. Then they, first of all, they add the import duty. Mostly it's at the rate of 20%, but we have various methods they use to determine on how to charge the import duty. So take the import duty. So that means the cost will increase and other taxes. Then later, they charge you VAT now on the total cost. They add the VAT, and that's how now you get the total cost. So you take the imports. Then we have some expenses. Not all the expenses, some expenses. Not all expenses are vatable. Some expenses are not vatable. For example, printing and stationery, they are vatable. You can claim. Audit fees, it's a professional service. It's a professional service. As an auditor, you need to add the value on it. So it will be taxed. It's also vatable. Salaries and wages. It doesn't have, right? So that's not something you cannot claim. Catering expenses, they are vatable, but there is something we mentioned. You cannot do what? You cannot claim. In short, shall not be deducted. Then we have some expenses such as bad debt. Now, bad debt, you can decide to put under the output tax but reduce, because most of the bad debt, they are associated with the sales on credit. So if the customer defaults and you have the evidence in defaults, you can deduct, or you put them, or you claim it under part of input tax. And then here we have the debit, note, receipt. Where we have the input, it's all about receiving. Where we have the output, is debit note issued, credit note issued. So on the input is debit note received and credit note also received. But for the credit note, you deduct that. Then how do you determine the amount of VAT to pay? So to get the amount of VAT payable or claimable, you take the output tax minus the input tax. But if this supplier was making all the three types of suppliers, you cannot claim everything here. If you're making all the three types of suppliers, it will be restricted. How do you restrict? To restrict, you take the taxable supply, you divide it by the total supply, and then you take that proportion into this. So you can copy that. And then make sure you have the past paper. I also shared with you the past paper. Let's do some illustration now. So now I'm back. Now let's do an illustration. September 2015. September 2015, question 5C. Question 5C. Now, someone is asking hapo expenses. Tulisema expense gani? Actually, most of the expenses in a company, they are vatable. All the expenses, except the expenses which are not vatable and the expenses which you cannot deduct. I hope Josephine, you are answered now. Which one? I'll explain, don't worry. September 2015. Question 5. Question 5C. So you're told that China Construction Company has been engaged in building and construction industry for many years. There has been an ongoing dispute with the Revenue Authority as to the amount of VAT the company is liable to pay. You have been provided with the following details relating to the company's transaction. So I think it must be there. And therefore, you can use your soft copy. So I thought that you have been provided with the following details relating to the company's transaction. So you're given all the purchases. Now the purchases will be part of the input tax. The above amount are inclusive of VAT at a standard rate of 16%. Now, if you're told the amount is inclusive of VAT, inclusive of VAT. In this case, what we want, we just want the VAT value. So how do you get that? Okay, if you're told that 100 is inclusive of VAT, how much is the VAT? 16% of? Very wrong. Yes, it's 1. Now, before you answer, listen to my question. Assuming that you are told that the value is 100 inclusive of VAT. Now my question is, how much is the VAT? The value or the cost of this pen, it's 100, which is inclusive of VAT. Are you together? So how much is the VAT on that pen? If you paid 100, you paid a VAT of how much? At the rate of 16%. 16, eh? Listen here. And now you start arguing like an accountant. So, if this 100 is inclusive of VAT at the rate of 16, that means this 100 is the same as what? Are you together? What about 16%? If you take 16% of 100, this is when the amount was exclusive of VAT. Now you're adding the VAT at the rate of 16%. So if it's inclusive, you argue that 100 is the same as 116. What about this 16? Can you give me that? So you take 16 over 116. You get 13.7. So if the amount is inclusive of VAT, if you want to get the VAT, you take 16 over 116. If the amount is exclusive of VAT and you want to get the VAT, now that's when you take the 16% of the value. Yeah, you take 16 over 100 or just 16% of that value. Good. I hope that's well understood now. Required. Advise the correct VAT position for the company for the period between May 2015 and August 2015. How many months are those? May and August. Or between May and August. Okay, now let's start with the input. We are given the purchases. We're given the purchase value. Number one, there was concrete mixer. That's part of the input. They are part of purchases. Concrete mixer. So we'll take 16 over 116. And the value was, yeah, can you see the invoice amount? Which was an amount of 5.8. Let's work with thousands. What do we get? Sorry? 800, 800. Number two, we have the scoffing pipes. Now we have pipes. You take 16 over 116, and the value was 1392. 190? 192. And then you have poker vibrator. Now we have poker vibrator. 16 over 116. You multiply by 696, you get 96. Then we have Xerox photocopier. That one you don't consider, or we consider. Now, I want you to look something. Now, can you look at the delivery date? It was on 30th of April. Invoice date? 10th of May. Payment date? Hey, are you on the same question? We say that. Okay, now let's go back to the requirement. Required. We are computing the VAT position between which month and which month? May and August. But if you look at Xerox photocopier, the delivery date was 30th of April. We say that the time of supply shall be the earlier. So that means for this photocopier, it will be for April. In this case, we are computing only between May and August. So that one does not fall into this. Are you together? Yeah, the time of supply should be the earlier of. So in this case, the delivery date was on 30th of April, but we want to compute only between May to August. So we don't factor in that. Then we have 10 trolleys. 16 over 116 of 25.52. What do you get? All right? 252, 352. Then we have executive boardroom table. Boardroom table. 16 over 116 of 464. That's 64. Then we have 2 tons of cement. Look at the delivery date. Yeah, 27th of April 2015. Do we factor that? No, we don't factor that. Good. Water dispenser for the office. That's 16 over 116 of 92.8. Sorry? 12.8. Paint from Duracoat. Take 16 over 116 of 812. You'll get 112. Number 10, office chair. Over 116 of 348. You get 48. Now give me the total input tax. The total input tax. Get 1676.8. Now let's look at the output tax. Additional information. The company had negotiated a contract for 45 million, for which it received a progressive payment of 18 million on 25th of June 2015. The amount are exclusive of VAT. The invoice had been raised earlier on 3rd of May 2015 based on the acted certificate for the value of work certified. Good. So that's what we call now the contract price, or the contract, the contract revenue, or the amount received. Let's do that again. The company negotiated a contract for 45 million, for which it received a progressive payment of 18 million on 25th June 2015. The amount are exclusive of VAT. The invoice had been raised earlier on 3rd of May 2015 based on the acted certificate for the value of work certified. So here we have the service income. So you'll take 16%. The amount was exclusive of VAT. How much did we receive? 80. Now these are long-term construction contracts, so we expect to receive the amount in bits. So in this case, the contractor issued certificate based on the work in progress, and we are paid 18. So you take 16% of 18,000, you get how much? 28. Number 2, the company had also won a labor on the contract. So he had also labor on the contract. The company had also won a labor on the contract for 12.5, exclusive of VAT, for which an installment payment of 4 million was received on 9th of May 2015, ahead of the completion on 17th of June 2015. Can you identify the completion date? 17th of June 2015. The invoice was raised for full payment on completion. You get that? So that means the actor issued the full invoice for the full amount, but we only received how much? 4. By the end of August 2015, the balance of the payment had not been received from the client. We read again. The company had also won a labor on the contract of 12.5, exclusive of VAT, for which an installment payment of 4 million was received on 9th of May 2015, ahead of the completion date on 17th of June 2015. So the contract price was 12.5, but you only received an installment of how much? 4 million. But you see, we completed within the duration. So we completed, we issued an invoice, but they paid just an installment. And then you are told that the invoice was raised for full payment on completion. So that means by 17th of June, the architect or the contractor had issued an invoice of 12.5. Now, how much do you charge me here? Now you will take 16%, not of what we received. We have already offered the services in full. We have raised the invoice in full. Therefore, they charge on the full amount, which is 12,500. Not based on what you received. You have already laid out the service. You get? 2,000. I hope you understand that. The same thing we say that if you sell goods to a customer worth 1 million and the customer pays 300, now when filing the VAT, you'll not charge based on this. You charge based because you have already offered the services. Good. So that means the total will be an amount of 14,880. So how much is the VAT payable? So we say that to get the amount of VAT payable, you take the output tax and then you claim the input tax. The output tax was 48.80. Then you less 1676.8. So this Chinese company, they are supposed to pay a VAT of how much? 22? But 203.2, which is equivalent to 3,203,200. Number 2 of the question. Comment on any information that you have not used in C1 above. Comment. I think I've explained everything. Number 1, for the purchases, you did not factor 2 items. Let's go to purchase number 4. Xerox photocopier. Also, purchase number 7, cement. So that's why I saw that you comment in information you have not used. You see, you have not captured that. What's the reason? The time of supply. Are you together? It just explained that. For the purchase, just mention the 2. See that the time of the supply is the area of. So the supply was made on April. Then, number 2. Number 2, this is what I was explaining here. The contract price was 12.5, but we only received an installment of 4. I think I've explained why you have used this, but we have not used what? The other 4. Good. That's what the examiner was asking. So let's copy. Yeah, and you practice more on VAT. VAT is one of the easiest, and it's one of the topics that does not miss. Yeah, with at least 9 months. Assignment. November 2019, question 2C. November 2019, question 2C. November 2019, question 2C. Yeah, actually it's the same question. It's a replica. They repeated everything. It's only the figure they changed. Now let's do another one. May 2017, question 4B. May 2017, question 4B. Let's start with question 4A. We have not yet covered that. Question 4A. Describe 3 tax planning opportunity that could be derived from the financial management decision in the company. This is another common area. In the handout, I'll share a handout, although we'll come to discuss it. Now, what is tax planning? Now, tax planning, there are measures taken by the taxpayer to minimize the tax liability. It's almost equal to what we call the tax avoidance. There is tax evasion and tax avoidance. Now, tax avoidance is the same as tax planning. The measures taken by the taxpayer to minimize all the tax liability. And they are classified into 2. We have from the individual basis and then as a company. Now, you as an individual, what are some of the measures can you take to minimize your tax liability? Number 1 is paying your taxes on time to avoid penalties, right? Also investing in government infrastructure bond. Because if you invest in government infrastructure bond with a maturity period of 2 years, the interest earned is not taxable. Also, consider acquiring a house through mortgage. Why? Because the interest on mortgage of a maximum of 300 per annum is exempt or is a deductible income, is a deductible expense. Also, contributing to the pension. So you're almost filing your returns, or you have already filed your returns. So there are some things you claim. Yeah. For example, if you are registered for a pension plan, the amount you contribute, it reduces your taxable amount. Does not mean that it reduces your tax expense. It reduces the taxable amount. Now, in this case, now they want as a company, describe 3 tax planning opportunity that could be derived from the financial management decision in a company. Now, as a company, what can you do? Number 1, also as a company, paying the taxes on time to avoid what? Penalties. Also, have tax experts to advise you. Don't rely by mere your normal accountant. Look for tax advice. And that's what most of the companies they usually do. They usually do outsource. Another thing, claiming for wear and tear for the assets. Also, offshore investment or tax haven, investing in tax havens. Also, having what we call what? There are this we call, registering the company as an EPZ, export processing zone. Also, choosing a supplier who is registered for VAT so that you can claim for input tax. What else can you do as a company? I thought we'll come to discuss that later, but I hope now you understand what we mean by the tax planning. Yeah, it's all about those measures you can take to minimize your tax liability. Good. Number B of the question. The foreign transaction related to Sawera Limited for the month of April 2017. So you're given all that information. Let's go to note number 6. Note number 6. Note number 6, we are told that the transactions are inclusive of VAT. And whenever you see a question on VAT, first of all, look at that point to determine whether the transactions are either inclusive or exclusive. If it's inclusive, 16 over 116. Exclusive, 16%. Good. Now let's start with the items. The first one we have is the purchases. So here we have the input. Right? So we have the output. Number one, we have the purchase of good at standard rate. Purchase is part of what? Input or output? Input. So we have purchases. So 16 over 116 of 626, 400. 86, 400. Exported goods to South Africa. Export zinatoka, so that means it's an output. So export to South Africa. How much is that? Yeah, you take 0% of 308 and you get an amount of 0. Yeah, exports, they are vatable at the rate of 0%. So 0 rate and exempt, they are totally different. For exports, I mean for 0 rated, you need to register for VAT, but in case you are making only the exempt supply, you don't have to register. Then we have sale at standard rate. So output sale at standard rate. So it's 16 over 116 of 11, 13, 600. One? Sorry? 156. 600. Then we have audit fees. That's an expense. Yeah. Audit fees. So it's 16 over 116 of that 7, 120. Get an amount of how much? 51? 120. Purchase of fuel and oil for delivery van. Purchase of fuel. Now, fuel is at the rate of how much? 8. But you see, the examiner has just 8%. It can be all the transactions are inclusive of 16%. Good. So 16 over 116, yeah, of 29. 4,000. Yeah. Then we have telephone bills. So 16 over 116 of 17,400. 400, 400. Exempt sales. That one is not captured here. Exported good to Zambia. Export to Zambia. That's a sale. 0% of 220. Get 0. Catering services. It's an expense, right? Do you claim? Now we say that one you don't claim. It's vatable, but you cannot claim. Then we have purchase of stationery. Stationery. That's 16 over 116 of 2880. Sorry? 2880. Cost of assigning a date for consideration. I know you don't know, right? Okay. Yeah, sometimes having a debt agreement, there is no value added on that. Are you together? Yeah, so in that case, it will not be vatable. Car parking, car park services provided by the county authority, not vatable. I say that the services from the government are not vatable. Treatment and supply of natural water, not vatable. Purchase of first aid boxes and kits, not vatable. Yeah, we see that. Yeah, the first aid kits, they are not vatable. Safety equipment, including the fire extinguisher. Additional information. The company issued debit note and credit note. Issued. It will affect which side? Input or output? Yeah, issue, it's an output. So here we have debit note issued, credit note issue, 16 over 116, 16 over 116 of 24, 360, and this one is, this one you get 3360, 48, yeah, but we say that for the credit note, you deduct because credit note was as a result of, we had made a sale, but the customer returned. That's what we call a return inward. Debit note issued. What does it mean? When we issue the debit note, that means we had undercharged our customer. We were supposed to charge him 1,000, but we indicated 9. Then you realize kuna 100 siku kuandikia. That's when you have to issue what? The debit note, correct. Number 2, the company returned good. The company returned good. Now let's be here. Don't overthink. The company returned good. If the company returned good, that means they had made a what? Not a sale. They had made a purchase. Are you together? Of this purchase, now we returned. So we have to reduce. That means we have credit note received. Are you together? Yes. So here we have return outward. That's what we call a credit note received. Let's do that. We are told that the company returned goods invoiced at 29,000 to supplier because they were of wrong type. A credit note was received immediately. So you take 16 of 116 of 29. That means we had already purchased, but we returned. So you eliminate that amount. 4,000. That means this 4,000 was included in this 86,400. So if we return, that's why we eliminate. Number 3, the company imported imports. So, and there is something I mentioned about the imports. If you're told the figures are inclusive of VAT, note that imports, they are exclusive of VAT. You have to factor in the cost, insurance, and freight. You add the import duty, and then you add VAT at 16%. The company imported goods valued 320. That's the cost, insurance, and freight. These goods were not included in the purchase figure. Import duty was at the rate of 20. So now you want to determine the VAT. How much will they pay? So the cost was 320. Then they were charged an import duty of 20%. So you multiply by 120 so that you get the total cost inclusive of VAT. I mean, inclusive of import duty. Now, once you get the total cost inclusive of import duty, then you charge them 16%. 61 for 40 goods. Number 4, the company transferred a branch as a going concern to another registered company at a cost of 450 at the end of April 2017. Now listen here. Now, previously, the transfer of assets or mostly transfer of business, they were not vatable. But nowadays, if you are transferring to another company as a going concern, you are selling the business. Your objective is to make the profit out of it. So you have to be charged the VAT. Any pattern? Yes. So previously, even if you check on my notes, I not provided for it. But nowadays, it's vatable. So transfer of branch. We sold the branch. We made some money. So 16 over 116 of how much? 450. Get an amount of how much? Sorry? 0? This is 69, 069. Good. Number 5, the company could not identify purchases at standard rate and they were sold at standard rate that were sold as exempt and therefore restricted deductible input tax. The transaction are inclusive of VAT, blah, blah, all that. So now give me the total. Oh, it's output 152, 160. Good. What about the input tax? Sorry? So now give me the VAT payable. You take the output tax minus output tax. Is it payable or claimable? Claimable. But there is something I mentioned. If the company makes all the 3 types of surprise, you cannot claim everything here. Are you together? Yes. The input will be restricted if the company makes all the 3 types of surprise. And we had our surprise here. We had the standard rate surprise. We had 0 rate surprise. And we had the exempt. We had all of them. So we have to restrict the input tax. But you look at the sales because you cannot use the purchase because we are told that. Can we go back to note number 5? The company could not identify purchases at standard rate that were sold as exempt. So if they could not identify the purchase, mostly we use the sales. Now let's start with the sales. Did we have the sales at standard rate? Yes. The sales at standard rate was an amount of 11,600, but was inclusive of VAT. So you deduct the VAT, which was 150, 3,600 to determine how much was the cost of those goods. Also of VAT. That's 960, right? Yeah, you take exclusive of VAT. Then we had 0 rate supply. There was export to South Africa, it's 0 rate, 380, plus export to Zambia, 220. So how much was the total 0 rate sales? 600. And then we had exempt sales. How much was exempt sales? Well, given it's 400, eh? Yeah, 400. That's 1 million. So it's 1960. So with this 1960, we need to restrict. So how do we restrict? So to get the deductible input tax, we said you'll take the taxable subprime, you divide by the total subprime, then you multiply by the input tax. We have our taxable subprime. Now, taxable subprime is the standard rate, which is 960. You add 0 rate, 600. Now, that's how you get the taxable subprime. Then you divide by the total subprime. The total subprime is 1960. Now, you get the proportion. Now, once you get the proportion, that's the only thing you can claim. Then you multiply by the input tax. Our input tax was 220. This one. This is 309, eh? Good. 220, 309. So how much can you claim, or how much would you claim? Sorry? 175? 348. Good. So that means the tax payable or claimable. Now, in this case, it's claimable because the output was less than the input, but the input, the maximum you can claim is how much? So in short, that means that within that month, the company made a lot of purchase compared to what they sold. Are you together? Yeah, that one happens. So you take 152, 160, you minus now the deductible 175. So that's the VAT claimable. So you can copy. Go and try also this one. So that marks the end of VAT. Shall do more question during our revision.